Okay, we're talking about infrastructure and energy alternatives. And when I say that, I mean the company, not the sector. I know it sounds like a sector call here, but no, we're talking about the company, and that's the name of it. IEA for short. Shares were down 16%, I think, at one point. Lot going on. Well, actually, not that much. There's one transaction that's really taking this down. Oaktree Capital Management is selling their shares. Now, they are affiliated with IEA LLC. Not quite sure that relationship, how that works, but the important thing is this Oaktree Capital Management has made some money. They want to sell their shares, lock in their profits. Pretty reasonable thing to do. Now, they own a ton of shares. Okay, they own 8 million shares, and there's 22 million shares outstanding. Okay, so that is a chunk of shares. I don't know what they got in at. I don't know. I don't see that anywhere. I don't know how I would figure that out, but I do know the shares were less than $2 a year ago, and they're now trading at 18. They closed at 21 yesterday, and I know the deal is for $16.75. So you may, why would they do that? Well, when you own 8 million shares and if you try to sell those on the marketplace, you'd probably get less than $16.75. You could do it over time slowly. That's, I don't know, it's just not always the best way to do it. They want to make a clean break. I'm fine with that. Okay, you want to do that. You made some money. Let's say we're in at $2. I don't know exactly, but let's just call it that. And you're getting 8 times your money by getting out, and you're locking it in by going through a broker. That's what the secondary offering is. They're just using a broker. Say, you guys buy our shares, please, and then resell them out in the marketplace. That's what's happening. Guggenheim's doing the deal. And there's a couple other people involved, but Guggenheim's the lead on it. So I think it makes sense for that. You got to take perspective here. If you're Oaktree Capital and you made that much money, maybe that it's just a huge weighting in their portfolio. They need to take that down to a normal size now, so they got to sell 8 million shares. There's a million reasons to sell. And I'm okay with it, right? All we care about is, are these shares worth more than they're trading at? And I think the answer is yes. Let's take a deeper look here. Let's go into our model. So here we go. Now, this is only been public for a little bit. It's an engineering firm, so they do have a high return on capital because, well, there's not really a lot of capital in an engineering firm. It's a people business. It's billable hours. You do a project, you get people on it, you charge, you kind of assess how many hours it's going to take, a couple of years for do a project, whatever it is. You kind of say, well, we're going to have 10 people on this job for X amount of time per week times the number of weeks, etc. You come up with some sort of price on a billable hours basis. The only capital you do need working capital to run that kind of business, especially if you're growing really fast. So that's why their return is so high. And we do a lot of engineering firms in our models, and they often look good because there's not a lot of capital. Money coming in is good return on that working capital. Okay. In fact, our valuation says it's worth 59, and I'm trying to be conservative. I tried to, we got a full fade in here. We got a low growth. It's probably going to do better than that, I would think. Okay. So, trading at 18.59, it's worth 59 according to at least this warranted value on this forecast. Another way to look at it, just trading at 6 times EV/EBITDA. That's very low. In the right space, right? Renewable energy and infrastructure. Lots of infrastructure, actually, not just renewables, but renewables is a big part of it. Let's look at the financials to get a little more flavor even. Just look at the growth. So this top line growth here that we calculate, that's compared to the same quarter the previous year. So March to March quarter, 278% return. growth in revenue, excuse me. 88, 51, 88, 88, 46, 23. Okay, fine, a minor dip in the latest quarter. Still 23% growth. It's a bigger company too, so I'm okay with that. I mean, there's a lot of good things happening here. Just, big shareholders cashing in. I don't have a problem with that. It's worth more. What else can I say? That's how secondaries work. Oh, I know what I was going to say. This has happened many times before. Great example is Northland Power. I remember this very specifically because I really like Northland Power. The chairman sold 750 million shares. It's like, whoa, for estate planning, right? You never really know. That's what they say. But like I said, there's a million reasons to sell. Maybe that was legit. Maybe he was ready to retire, and estate planning and taxes and a million reasons to sell. Shares, similar kind of reaction. And he did a similar type of deal. It was a bought deal through a broker, a secondary. And now those shares are up 100%. So his estate planning, his estate might be better off if his planning was to hold on to those shares and they were 100% higher. But hey, look, we don't know the situation. Maybe you just, you can't have all your assets tied up in one thing. So nothing wrong with that. I'm okay with it. Okay, that's the situation. I'd say bye. IEA, great company, great space. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or a retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.